Next up, I'm going to talk about several qualities that make a successful investor. There are actually many, like uncountable amount of qualities to make a successful investor, but I'm just going to highlight three key ones. So quality number one, patience. So when we think of successful investors, we often think of people who are able to make quick decisions and take advantage of opportunities in the market. And while that can be part of investing, the most successful investors are those who have the patience to stay the course even when things get tough. So what do I mean by patience in investing? So I mean having the discipline to stick to your long-term investment plan even when the market is volatile or your investments are underperforming. So it means not getting caught up in short-term trends, short-term market fluctuations, or trying to time the market, but instead focus on the big picture and staying invested in the long haul, like we've seen earlier in patience. Now, I know that might sound easier said than done. After all, investing can be an emotional roller coaster. It's natural to want to react to what's happening in the market. But the truth is, the most successful investors are those who are able to keep their emotions in check and stay disciplined, even in the face of uncertainty. So this is a quote by Warren Buffett. So Warren Buffett is a very, very famous investor. He says, the stock market is a device to transfer money from the impatient to the patient. So, in simple words, it means that the impatient will lose their money and the patient will get money. So, what are some of the benefits of patience in investing? Here are a few. So, first, patience allows your investments to compound over time. So, by staying invested for the long term and reinvesting your dividends, you can take advantage of the power of compounding, which can lead to significant returns over time. So as you can see from the first point, this is actually a statistic taken from January 1971 to July 2022. And it says that if you have randomly picked one day during this period and chosen to invest for just 24 hours, you would have a 52.4% chance of making gains. This is roughly similar to the odds of tossing a coin, head or tails. Although I wouldn't recommend you to try it because many stockbrokers have fees, so for making a trade as well as spreads. So even though the probabilities, which states here is 52.4%, the actual probability is probably lower than that. But anyway, the point I'm trying to make is that long-term investing dramatically increases your chances of returns. So 24 hours gives you about 50%. The longer you stay in the market, the longer you stay in the market, the longer the higher the probability this becomes. So this chart, the x-axis shows the holding period, so that means how long you hold your stocks, and the y-axis shows the historical probability of positive returns. So as you've seen earlier, roughly holding 24 hours is not exactly that, but holding it, let's say for 1 month, gives you about 55% return. And you can see as time increases, the probability of making returns increases. And let's say 10 years, the probability is almost 90%. Hold it for around 13, 14 years, it almost reaches 100%. So this is just to emphasize the point that you want to hold your stocks as long as possible, a good company as long as possible, um, because this increases your probability of getting huge returns. So this chart basically shows the opposite. So again, the y-axis is the historical probability of loss. So instead of profit, now I show you the loss. If you hold it for a little while, you can see the probability of making a loss is slightly less than 50%. This is in line with if the probability of breaking profit slightly more than 50%. And as you hold longer, um, 15 years, the probability almost goes to zero. So it's a no-brainer. You don't lose any money if you hold a good company for a very long time. The probability of it is almost zero. So patience also allows you to avoid costly mistakes. So in the short term, the market fluctuates, as I mentioned before, which means the stocks will go up, the price of stocks will go up, you'll go down. Your portfolio might sometimes look red, very red, or it might sometimes look green. So when you're not constantly buying or selling, you're likely to make these impulsive decisions that could hurt your portfolio. This means that you won't be impulsive when seeing your stock portfolio turn red and quickly sell your stocks. That I would say is one of the biggest um, pitfalls of a amateur investor. So patience allows you to stay focused on your long-term goals. So by having a clear investment plan and sticking to it, you're more likely to achieve the outcomes you want, whether that's saving for retirement, funding your children's education, or achieving financial independence. So earlier, the previous point, we saw how probability of making gains is 52.4% in 24 hours. However, just reading from this next point, it states it's estimated that 90% of investors lose money in the stock market. So how is this possible? If you're making if the probability of making money is just a flip of coin, why do 90% of all investors lose their money? So one of the biggest reasons investors lose money is a lack of knowledge and education. So many people are drawn to investing because they believe it's a quick way to make money without investing much time and effort. They just follow the hype, buy it. However, this is actually a very dangerous misconception that often would lead to loss. In, so investment is actually a professional thing. It must be taken seriously, like any other money-making venture. So else it'll be the same as gambling. There's basically no difference if you just buy a stock just for fun. It's like gambling. No difference from a casino. So there are two major emotions in play when people lose money. The first is caused by something called Mr. Greed, and the second is caused by Mr. Fear. So fear can cause investors to panic and make very, very rash decisions, while greed can lead them to take on excessive risk and chase unrealistic gains. Um, Also, there are other emotions, for example, like hope. Hope can usually make people hold on to losing positions for too long. Um, and regret can also cause people to second guess their decisions and miss out on profitable opportunities. So this is what an investor without a plan look like. They get swayed by all these emotions, like Mr. Fear on one side, Mr. Greed, and then regret here, and um, hope on the other hand. So you get swayed by all these four emotions shifting you around, and that's what it looks like if you don't have a proper investment plan. So another common mistake that people make is overtrading. So invest overtrading means when a person makes too many trades, often based on impulse or emotion rather than actually kept following his plan. So not only does overtrading leads to higher trading costs because for every time you buy a stock, most brokers charge a fee, like I mentioned earlier. It also leads to missed opportunities and a lack of focus and direction. Um, it can also lead to too much risk and poor trading decisions because we have seen earlier, like the longer you hold, actually the safer it becomes. So if you sell it too fast, you're actually taking more risk. So to avoid over trading or over investing, you must have a clear plan which outlines a strategy. You should set realistic goals and avoid temptation to make investments outside your plan. And I'll talk about this planning more so later. Another fun bit of statistic you can see in point three, the average investors hold shares for 5.5 months. This clearly indicates that the person is over trading. So remember what we saw in the charts earlier. The longer you hold a stock, a good business stock, the higher the probability. So 5.5 months coupled with brokerage fees, when look here is about 55%, covered with the brokerage fees is definitely below 50%. And I can tell you that's why 90% of people lose money when going to the stock market.